Get funded today. That is the promise. And I have some thoughts. I'm Ken Rolliger, and welcome to episode 25 of The Joint Prop from Funded to Zero podcast.
I'm Jessica LaRusso.
And today we are getting into something that has completely just entirely taken over my feed. And probably yours too, if you've even glanced at a trading chart online, or honestly even just opened social media in 2026. Instant funding prop firms.
Yeah, they're literally everywhere right now.
Everywhere. And the whole idea is bypassing the evaluation period, right? Because traditionally you'd have these two-phase challenges, hit 8% profit in phase 1, 5% in phase 2, and wait 60 days just to...
Okay, wait, hold on, stop. Let me back up, because you are already miles down the road here.
Oh, my bad, yeah.
No, I mean, for someone listening right now who is just curious, who isn't living in the day trading trenches every single morning, what do you even mean by an evaluation period? People see the ads, you see the shiny cars, the yachts, the insane promises of overnight wealth. But I think we need to actually translate this whole ecosystem before you just tear into the mechanics of it.
Right. Yeah. Okay. So the thing is, okay, wait, let me back up. Let me start from the absolute baseline. Traditionally, a proprietary trading firm, a prop firm, gives you their money to trade. That's the core concept.
Right.
You trade their capital, you split the profits, but they don't just hand it to you off the street. You have to prove you aren't terrible at this.
Because they'd be insane to just hand over cash to anyone.
Exactly. You have to prove you aren't going to just gamble it on a single meme stock.
Yeah.
So you pay a fee to take a test. They call it an evaluation or a challenge. And historically, it takes weeks, sometimes months.
So you're trading fake money to prove yourself.
Yeah, a simulated demo account. And you have to hit very specific profit targets without losing too much money. Make $8,000, but don't lose $5,000, and you have to do it over a minimum amount of trading days. If you passed all their hoops, then you get the funded account.
Got it. So it's a tryout, like making the team before they give you the jersey.
It's a tryout. But what has exploded in the market as of this year, the dominant force right now across the whole industry, is instant funding.
Meaning no tryout.
Bypassing the tryout entirely. Skipping the line, you just pay a fee, and boom, you're trading a live account, or at least an account that pays out real money on day one, minute one.
Which just sounds so wildly risky on their end.
And the mechanics of how these firms operate, honestly, it is a masterclass in risk management on their end, but also kind of like a complete minefield for the trader if you don't know what you're actually looking at.
Which is exactly why we are tearing this apart today. Because you, the listener, you are seeing these ads everywhere. You're scrolling and seeing, skip the test, trade $100,000 today.
Yep. Every other post.
You're naturally curious, because who wouldn't be? But you also don't want to get played. You know there's no such thing as free money. So we're looking at the actual mechanics, the raw, brutal math, and trying to figure out who is actually making money here.
Because it's not always the guy in the ad.
Yeah, definitely not the guy in the ad.
So let's just get right into the core mechanic, the actual business model, because it's actually incredibly straightforward on the surface, which is how they hook you.
Okay, walk me through it. I'm on the website. What do I do?
Step 1, you pick an account size. And the range right now is massive. It used to just be small accounts, but now you can start with a $10,000 account all the way up to over $1 million.
$1 million, just off the shelf, like you're adding it to a digital shopping cart.
Literally off the shelf.
Yeah.
Assuming you have the cash for step 2, which is paying the one-time upfront fee, you want the big account, you pay the big fee.
And how much is the fee usually?
So the current market standard right now, the stats we're seeing across the board and the data we pulled, is that this fee sits between 4% and 8% of the total account value.
Wait, okay, I need to do the math on that. 4 to 8%. So if I want to trade a $100,000 account,
you are paying $4,000 to $8,000 up front, out of your own pocket today.
Wait, that's literally their business model. That feels like a scam.
It's not a scam.
I'm not saying illegal. I'm saying it feels like one. You're telling me I have to lay out $8,000 of my own actual money just for the access to trade their money?
I mean, yes, you pay for access.
I'm essentially just buying my way into a casino. I'm paying the pit boss $8,000 just to be allowed to sit at the blackjack table.
Now, see, that's where the math actually gets really compelling if you know what you are doing, if you are a professional. Because in return for that upfront fee, the profit splits are massively, massively trader favorable.
What do you mean by favorable?
We're talking 70 to 90% of the profits go to you. Not 50-50, 90%.
90%, 90. I need a second.
Yeah, 90. And in a lot of these firms right now, the infrastructure has gotten so fast, You can withdraw your cut in like 1 to 5 business days.
Okay, but I'm still stuck on handing over $8,000. $8,000 is a used car. $8,000 is a massive chunk of savings for a normal person. And you're just wiring it to a random firm on the internet.
Because you have to look at it through the lens of capital efficiency. That's the argument the industry makes. And honestly, the math backs it up if we are talking strictly about professionals. Think about it.
Okay, I'm thinking.
If you have $5,000 of your own money, you could just put it in a retail brokerage account.
Yeah.
But your buying power is tiny. You take a trade, you make a 1% return on that trade. Congratulations, you made $50.
Right, which pays for like half a grocery run.
Exactly. You can't live on $50.
Yeah.
But with instant funding, you take that same $5,000, you pay the fee, and now you are trading a $100,000 account. You are instantly getting 20x leverage on your initial investment.
So the math just scales.
It scales dramatically. You make a 1% return on that $100,000, you just made $1,000, and you keep up to 90% of it.
Assuming you don't lose it all in the first 10 minutes.
Right. But for an experienced trader, being able to capitalize on emerging market opportunities right now without grinding through a 2-month tryout, that 20x leverage is incredibly powerful. It's about access to buying power.
But leverage is always a double-edged sword.
Oh, totally.
Yeah.
Like, think about margin. Actually, wait, no, let me rephrase. I'm overcomplicating it.
Let's not get into margin calls.
Margin gets into borrowing costs and interest rates and maintenance calls. Let's just stick to capital efficiency. It's like, okay, imagine you're a gold miner.
Okay.
You have a little plastic hand trowel. You can dig all day and find a tiny nugget. Or you can take your savings, rent a massive industrial bulldozer, and dig up the whole mountain in a week. You are buying a larger shovel so you can dig more gold faster.
I get the shovel analogy. I really do.
Okay.
And I see how 20 times the buying power sounds amazing on a spreadsheet.
It does.
But I still can't shake the feeling that the firm is taking zero risk. If I give them $8,000 to access $100,000, what is their actual protection?
Oh, they are very protected.
Why would any rational financial institution just hand over a massive account for a 5 or 8% fee? Because if I go in there, start clicking buttons like a maniac, and immediately lose $50,000, they are at $42,000.
Right.
There has to be a catch. There is always a catch when someone is handing you leverage.
There's a massive catch, a humongous catch. And this is exactly where the razor-thin margins come in. This is the part that TikTok ads kind of gloss over while they show the guy stepping out of a Lamborghini.
Because of course they do.
They don't just hand you $100,000 and say, go nuts, kid, we trust you. The trading parameters are incredibly strict, specifically the drawdown limits.
Okay, stop right there. Define drawdown for the listener, because we throw that word around, but what does it actually mean in this specific context?
Drawdown is essentially how much your account balance is allowed to drop from its peak or from its starting balance before the firm pulls the plug. It's your leash.
Okay, so how much can you lose?
And the stats for instant funding firms are brutal. They're unforgiving. Daily drawdown limits are typically just 3 to 5% of the account. And the overall maximum account drawdown is capped at 8 to 12%.
Wait, 3%. 3. I need a second. Let me run this math again because this changes everything.
Run it.
So if I have that $100,000 account that I just paid $8,000 for, I can only lose $3,000 in a single day.
Correct. $3,000.
But wait, $3,000 is less than the $8,000 I paid to get the account in the first place.
Bingo. Now you see the matrix.
Oh my God. So I'm not even trading their money. I'm literally just trading my own fee.
Pretty much.
I gave them $8,000, they let me lose $3,000 of it, and then they fire me and keep the difference.
Yeah.
I'm trading my own money plus maybe a tiny bit of buffer, but with the illusion of a $100,000 position size.
Yep. The position sizing is the illusion of wealth.
If I sneeze and the market drops $3,000, I hit the daily limit and I lose the account. I lose my $8,000.
You lose the account, yes. Immediately. Automatically. It's hard-coded into their system.
That is wild.
And this brings up a massive debate in the space right now because there are two completely different ways to look at this. The source material we're looking at, the industry perspective, claims that trading these real accounts from day one gives you a psychological advantage.
A psychological advantage? How?
They argue that because the parameters are so tight and because it's real money, your fee on the line instantly. It creates more disciplined execution.
Yeah.
You don't have the luxury of being sloppy. You are forced to be a sharper trader.
I am going to push back on that so hard. I don't care what the industry paper says. That doesn't create discipline. That creates absolute panic.
I mean, for some people.
If I know that a 3% dip, which, by the way, in a lot of volatile markets right now is nothing, it's a normal Tuesday morning. If I know that tiny dip blows up my $8,000 investment, I'm going to be trading from a place of pure fear.
But fear can be motivating.
You're constantly staring at the execution blade waiting for it to drop.
I hear you. But honestly, without that skin in the game, traders act like they are playing a video game. I've seen it a million times with demo accounts or loose parameters.
No, yeah, fake money makes people reckless.
Exactly. People just swing for the fences. They take massive position sizes because it doesn't hurt when they lose fake money. The instant funding model, with that tight 3% daily limit, it forces you to abandon bad habits.
Does it, though? Or does it just break you fast?
It forces it. You can't hold and hope. You can't let a loser run and pray it turns around. The parameters enforce the discipline that retail traders usually completely lack.
No, I refuse to concede that. A 3% limit is like driving a Formula One car where the steering wheel snaps your wrists if you turn it more than an inch.
Okay, that's a bit dramatic.
That's not forcing me to be a better driver. That's just a trap designed to break my wrists. How do you even survive a 3% daily limit? One bad piece of news, one weird algorithm spike, and you are done.
You survive it by using extreme risk management. That's the whole point. The survival guide for these accounts is basically military-grade discipline. You cannot treat them or trade them like a normal retail account.
So what are the actual rules for survival then?
The source lays out exactly what's required to survive these margins, and it's a lot. First, you have to set a personal daily loss limit at 50 to 60% of the firm's maximum.
Meaning, wait, if the firm will fire you at a 3% loss, you have to fire yourself for the day at a 1.5% loss.
Exactly. You never, ever let the firm be the one to stop you out. You walk away first.
So your actual working room is 1.5%.
If your account drops by 1.5%, you shut your laptop, you go for a walk, and you do not trade again until tomorrow.
That takes a crazy amount of self-control.
It does. Second, position sizing has to be incredibly conservative. We are talking risking only 0.5 to 1% of the account per trade.
Let's do the math on that again. So on our 100 grand account, you are risking $500 to $1,000 per trade. Right?
Which, again, translates to a very different psychological reality than having 100 grand. You aren't managing 100 grand. You are managing a $3,000 lifeline while holding a massive grenade.
Yeah, I guess that's one way to picture it.
If you're a cowboy who likes holding through massive dips or, averaging down when the trade goes against you, which is what a lot of resale traders do, this structure will literally chew you up and take your upfront fee in 3 days.
3 days. Try 3 minutes. Honestly, if you trade the open on a volatile tech stock without a stop loss, you will be gone before your coffee gets cold.
Right, because the swings are just too big.
Which is why the third mandatory survival rule is so critical. Automated stop losses on all positions. You cannot mentally tell yourself, I'll close it if it hits this level.
Because you'll freeze.
You'll freeze or you'll rationalize. You have to have the hard stop physically entered into the system the second you take the trade. Because a flash crash or even just regular slippage... Wait, explain slippage for the listener. Because people assume if they click a button at a certain price, they get that price.
Yeah, that's a huge misconception. Slippage is when you tell the broker, sell my position right now at $50. But the market is moving so fast that by the time your order reaches the server, the price is $49.50.
So you get filled at a worse price.
The broker fills you at the worst price. You slipped. Now, in a normal account, 50 cents of slippage is annoying. In an instant funding account where you are only risking $500 total on the trade, slippage can instantly push your loss from 0.5% to 1%.
So just the mechanical delay of the internet could cost you half your daily limit.
If that happens twice, you've hit your personal daily limit and you're done for the day. So the automated stop loss is your only shield against the market moving faster than your finger.
So it's a tightrope. A very, very expensive, incredibly stressful tightrope suspended over a pit of fire. Which honestly begs the question, who is this actually for? Because the marketing says, get funded today, and it shows a guy casually trading from a yacht with a mojito. But everything you just described sounds like a stress test for a highly calibrated financial robot. It sounds miserable.
Well, the ideal candidate is very specific, and the source material is quite clear about this. This is built for traders with a proven, consistent methodology.
Meaning people who actually have a system.
People who have rigorous risk management discipline and a deep, deep understanding of their own performance metrics. You need to know your exact win rate. You need to know your exact average risk-to-reward ratio.
You need to be a data nerd.
You have to know that if you lose 4 trades in a row, the math says your 5th trade will pull you out of drawdown. Oh, and obviously, you need available capital to burn on the initial fees, knowing that losing it is a very real, mathematically probable possibility.
So professionals. You are describing professionals.
Basically, yeah. Unfunded professionals, or professionals looking for scale. People who have the skill but lack the capital to make life-changing money. And there is a massive warning label attached to this in the material.
I bet.
It explicitly calls out who this is not suitable for. It is not for beginners who are still developing their risk management. And it is not for anyone without a proven, consistent strategy, period.
Okay, this is where I get really heated about the hypocrisy of this entire industry. I really do.
I mean, it is what it is.
If this tool is explicitly not for beginners, if the math requires you to be a stone-cold killer with your risk management, why is the marketing screaming, "Get funded today"? Why is it all over social media with flashy graphics and affiliate links?
Because they have to acquire users, right?
You and I both know that professional, disciplined traders with proven methodologies are not the ones clicking on a TikTok ad at 2 in the morning.
I mean,
No, think about it. Walk through the logic here. The entire 4 to 8% upfront fee model secretly relies on beginners.
I wouldn't say relies.
It relies on novices ignoring that warning label, ponying up the fee because they want the yacht, blowing up their accounts in 48 hours because they don't understand position sizing or slippage, and essentially keeping the lights on for the firm.
Okay, wait. You're making a massive...
The beginners subsidize the payouts for the professionals. That's the real business model. And it's a slaughterhouse for the 99% to pay the 1%.
Okay, you are making a massive assumption there about intent. I will admit, bluntly, yes, a lot of beginners fail. A staggering amount of people blow their accounts.
Yeah.
But I fiercely defend the tool itself.
But you see my point about the marketing.
You cannot blame the prop firm if an amateur decides to step into a professional arena without a proven strategy. It's a tool. If I go out and buy a Formula One car and I immediately crash it into a wall because I don't know how to handle the torque, you don't blame the car manufacturer.
A car manufacturer doesn't sell Formula One cars to teenagers with a learner's permit. That's the difference.
They aren't checking IDs for skill levels.
These firms are explicitly marketing to people who do not have the skills to survive the 3% drawdown limit. They are selling the dream of $100,000 to kids who only have $8,000 to their name.
But they are offering a service. It's a tool for the proven. It's not a lottery ticket for the unproven. If someone chooses to treat it like a lottery ticket, if they decide to gamble their fee on a single earnings report instead of using a 0.5% risk model, that is on them.
I just think it's predatory.
Personal responsibility has to exist somewhere in this conversation. The capital efficiency is real. The 80% profit split is real. For the trader who has spent 2 years refining a strategy, logging their trades, backtesting their data, and just lacks the capital to make a living wage from it, this model is life-changing. It completely levels the playing field against Wall Street.
I don't disagree that it's a powerful tool for the right person. I'm just looking at the reality of who is funding the ecosystem. The math requires a constant influx of losers to pay the winners.
That's trading in general, though.
But, okay, let's step off the soapbox for a second. Let's say someone listening actually is ready. They have the spreadsheet, they know their metrics, they are disciplined, they just need the capital, they want the F1 car. How do they actually pick a firm in 2026 without getting burned? Because new firms pop up literally every week.
Yeah, that's the real challenge right now. The selection criteria is crucial. Because if you give your $8,000 to a shady firm, even if you are a great trader, you might never see a payout. First thing you have to look at is reputation. Specifically operational history. You need to look for a minimum of 2 to 3 years in business.
Which is hilarious, right? Like in the prop space, 3 years makes a firm a dinosaur. You're an ancient legacy institution if you've been around since 2023.
Honestly, yeah. It sounds absurd, but it's true. And the reason you need that history is because of how the payouts work. A lot of these fly-by-night firms launch, they collect a massive pool of upfront fees from beginners, and everything looks great for a few months.
Because they haven't had to pay anyone out yet.
Exactly. But then, the profitable traders actually request payouts. And if the firm hasn't managed their own risk properly, or if they're just running a Ponzi-style operation with the fees, they suddenly fold and disappear overnight.
Which has happened. We've seen that happen.
We've seen it a dozen times. You wake up, the website is down, and your account is gone. So you need that operational history to prove they actually have the liquidity to pay out consistent winners over time.
Okay, so history is step one. What's step two?
Second, you have to read the fine print on the trading parameters. We talked about drawdowns, but that's just the headline. You also have to check position sizing rules and holding restrictions like can you hold trades overnight or over the weekend?
Because holding over the weekend is terrifying with real money, let alone with a 3% leash. I mean, think about it. The market closes on Friday afternoon. Everything is fine. You leave a position open.
Yeah.
Saturday morning, some massive geopolitical event happens. A war breaks out, a bank collapses, whatever. You can't do anything. You are just watching the news, knowing your account is doomed. When the market finally opens on Sunday night, it gaps down 4%. It skips right past your stop loss.
And your account is instantly blown.
A weekend gap could blow your account before the market even officially opens and gives you a chance to click a button.
Exactly. Which is why a lot of professional instant funding traders flat out refuse to hold over the weekend. They close everything Friday at 4 p.m.
Right.
But some firms don't even give you the choice. They explicitly ban weekend holding.
Which is probably for the best, honestly.
You have to know if your firm does that. And then there are policies on trading during news events. Some firms will insta-fail you, like literally pull your account if you execute a trade within 2 minutes of major economic data drops,
Right.
like CPI or non-farm payrolls.
Wait, for the listener who isn't glued to Bloomberg, explain why non-farm payrolls is such a big deal.
Non-farm payrolls, or NFP, is the U.S. jobs report. It usually drops on the first Friday of the month at 8:30 a.m. Eastern, and it is pure chaos.
Chaos how?
The moment that number drops, algorithms at major institutions process the data in microseconds and flood the market with orders. The price can spike 50 pips in one direction, then instantly reverse and drop 100 pips in the other direction within 3 seconds.
So it's basically untradeable for a human.
Completely. The difference between the buy and sell price widens massively. It's incredibly unpredictable.
So if you have a tight 3% drawdown limit and you try to trade during NFP, the volatility could hit your stop loss, skip past it due to slippage, and blow your account before you even realize what happened.
Yes. It is financial suicide for a tight margin account. So a lot of firms just say no trading during high-impact news. You have to know those rules cold because ignorance is not an excuse. They will take your account, point to page 42 of the terms of service, and say thanks for the fee.
Ugh. Yeah. Always read the fine print.
Always. And finally, for selection criteria, you have to compare the actual economics. Don't just look at the fee percentage. Look at the profit splits and look at the scaling opportunities.
Scaling meaning they give you more money to trade if you prove yourself.
Right. Does the firm increase your capital allocation if you are consistently profitable? If you make 10% over 3 months, do they bump your 100 grand account up to 150 grand?
Which essentially compounds your ability to make money without risking more of your own.
Because that's how you actually build wealth in this space. You leverage their capital, prove you're safe, and let them scale you up to $1 million.
So it's essentially doing due diligence on a business partner, because that's what they are. You aren't just buying a product, you are entering a legally binding revenue share agreement.
Exactly. And looking at where the data shows this is going next, the landscape is shifting. The industry is evolving really fast. The instant funding model is maturing beyond just the upfront fee. We're starting to see a shift from one-time fees to subscription models.
Ugh. Stop. I am so sick of everything becoming a subscription.
I knew you were going to say that.
I don't want a subscription for my heated car seats. I don't want a subscription for my printer ink. And I definitely don't want a monthly subscription to Access Trading Capital. That just adds a massive recurring psychological pressure to perform.
It does change the psychology.
If I have a slow month, or the market is just chopping sideways and giving no good setups, I still have to pay the fee. That forces over trading. You'll take garbage setups just to try and cover your monthly nut.
Well, yes, it definitely adds pressure, but the flip side is that the barrier to entry might be lower. Instead of 8 grand up front, maybe it's $1,000 a month. For some people, cash flow-wise, that's easier to swallow. It lowers the immediate risk.
I guess, but it feels like renting a treadmill instead of buying one. You just never stop paying.
And if you have a bad month, you just cancel the subscription instead of losing an $8,000 sunk cost. We're also seeing a really positive trend. Performance-based fee refunds, where if you hit a certain profit milestone, say you make 10% on the account, the firm actually gives you your initial upfront fee back with your first payout.
Now that I like. That actually aligns the incentives. It rewards actual survival and profitability instead of just rewarding the firm for collecting your failure fee.
Yeah, it changes the dynamic from adversarial to cooperative.
Yeah.
And then there's API integration for algorithmic trading, which is becoming huge.
Sure.
And expanded cross-border accessibility, meaning more global traders, people in emerging markets getting access to these massive pools of capital. The space is becoming much more tech-driven and globalized.
Wait, I want to circle back to one of those. API integration, like plugging a Python script directly into the broker. How does that even work when the margins are this tight?
It works perfectly because the margins are tight. You write an algorithm, a set of rules, you plug it into the broker's API, it scans the market 24/7.
So no human error.
When a setup matches your exact criteria, it executes the trade in milliseconds. It automatically calculates the 0.5% position size. It automatically places the hard stop loss. No human emotion, no hesitation, no panic when the trade drops 1.5%. It just executes the math.
Wow. Okay, let's look at the real takeaways here, because we've covered a staggering amount of ground and ripped this whole model apart. For me, the biggest thing is that the math is genuinely incredible if you're already a profitable trader. Getting 20x leverage immediately is a massive accelerator for your career. But the flip side, and this is a huge glaring, but the daily drawdown will eliminate you instantly if your risk management is sloppy. You cannot hide bad habits in this model.
Yeah. You cannot treat a $100,000 funded account like a $100,000 personal account. You have to treat it like a $3,000 account with a lot of buying power.
Yeah.
That psychological shift is everything. If you don't make that shift, you are just donating your money to the firm.
And something you just mentioned about the future trends is really sticking with me as we wrap this up. You mentioned the API integration for algorithmic trading.
Yeah, the bots.
If the margins for survival are this tight-risking 0.5% per trade, needing flawless execution to avoid hitting a 3% daily limit, avoiding slippage during news events, are humans eventually going to be phased out of instant funding entirely? Like, are we just transitioning to a space where it's only bots trading these accounts because human emotion is simply too much of a liability for those strict parameters?
That is a genuinely terrifying and probably completely accurate thought. If the rules are rigid and the punishment for breaking them is immediate termination, the best player in that game is always going to be a machine.
Yeah, which is wild to think about.
We will definitely have to dig into algorithmic prop trading and the rise of the bots in a future episode. But for now, that is the raw landscape of instant funding today. It's a massive opportunity and a massive trap. Thanks for hanging out with us for episode 25 of the Join Prop from Funded to Zero podcast. Catch you on the next one.